Hi friends, welcome to A to Z Learning channel. Today's video is about dividend equity stocks and dividend mutual funds. There's always a dilemma whether one should invest in those stocks which have a long history of paying high dividends, or should you go for dividend paying mutual funds as against growth option of mutual funds. So this question comes in our mind all the time. So in today's video, we are taking stock of the current tax rules, and in the current tax rule context will help you assess whether dividend paying stocks or mutual funds are still good to invest or not. So it's going to be a very important video for you. So please stay with us until the end of the video. And if you've not subscribed our channel A to Z Learning, I would urge you to subscribe our channel so that you get immediate notification about all our new videos. So without further ado, let's start our video. So first of all, let's take stock in terms of some of the key points which set the context in terms of our ability to assess whether dividend paying stocks and mutual funds are still good to invest or not. So first of all, investors historically have really liked the dividend paying stocks and mutual funds. There is some special love for regular liquidity, regular kind of income coming from dividend paying stocks and mutual funds. People have in fact preferred these things over some of the other options of investing money in direct stock or mutual funds. So as an investment community, it is fair to say that we've historically had a liking for dividend paying stocks and mutual funds. But last year, there was a major change that was brought in the last year's annual budget. They made the dividend income taxable, whether it was coming from the stocks or mutual fund. Now, the dividend that is received by investor is taxable as normal income. What does it mean effectively? In the past, when you used to get the dividend, it was tax free. It didn't matter whether you were getting that as part of the growth in the value of your stock or mutual fund, or you were receiving some payment on an annual basis as dividend and rest in the form of growth in your value of stock and mutual fund. But now there is a big difference because the amount that is paid as dividend every year or every 6 months, that is going to be treated as your normal income. And if you are one of those people whose annual income is already at the higher tax slab, which is 30% plus surcharges and cess that are applicable, then you receiving dividend income would effectively mean that you will be paying 30% tax on that. So I think that's a very important change that was brought in the last year budget. You need to keep that in mind as we kind of look forward and assess what need to be done going forward. Now let's also take stock in terms of what happens if it is a capital gain. So there are two type of capital gain taxes. Capital gain is basically means that the profits that you make by selling equity stock or mutual fund. So that profit that comes from the sale is called capital gain or capital loss if you're making losses. So there are two type of capital gain taxes. First one is the long-term capital gain tax, which is 10% in India. The long-term capital gain is basically the profits that you realize on a share which has been held at least for a year. So your date of purchase and your date of sale, if the period between your purchase date and the sale date is at least 1 year, then it will be considered as a long-term capital asset. So when you'll sell, whatever profits you will realize, those will be classed as long-term capital gain and they are taxed at 10%. The second capital gain tax is the short-term capital gain. So effectively, when you hold the shares for less than 1 year, it is seen as a short-term capital gain. And that gain is taxed at 15%. So it's still not too bad. Long-term capital gain is the lowest tax, 10%. But even at a short term, even if you say hold the stock for 1 day or 2 days or 1 month or 1 week, you would still be subject to 15% tax on the gains that you will make on that stock. It is still better than receiving as a dividend, which is now taxable at 30%. So that's another point to note. One last point to highlight is that number of us may be trading in the intraday transaction. So we're basically purchasing and selling the stock on the same day. That is considered, as per Indian tax law, a speculative income. A speculative income is taxed like any other normal income. Therefore, if you are in the higher tax slab rate, then your intraday profits will also be subject to 30%. These are not taxed as capital gain. So that's also an important point to keep in mind. While I completely understand that intraday transactions are done for a number of different reasons, but the tax context that we are discussing in today's video is important to keep in mind for intraday profits as well. Hope you're still kind of following me. It's you're kind of understanding what all I've shared so far. If you have any question, please let us know those questions through the comments, and we'll come back to you with answers of those questions at the earliest possible. So now let's move to the second part in terms of this is as a context in our mind. Now the ultimate question is that what should you do? Whether it is still good to be investing in dividend paying stocks or not. So let's talk about that now. So what is best for you? Let's first take the dividend paying stocks and assess whether what is best for you in this. Typically what happens is that when a company declares the dividend, and on the date of payout, when the dividend is paid, the value, the purchase, the traded price of that stock is reduced by the value of dividend. They call it X dividend rate. Of course, very next day or the same day, it could go further up or down as well. But the starting point is if a company's stock is, say, trading at 200 rupees, they declare a dividend of 20 rupees. On the date of payout, the stock ex dividend stock price would be 180 for you. So effectively, it means that whatever gain you had at a price of 200, that gain is that part of that gain, which is say 20 rupees in this example, is paid by way of dividend to you. So you're still getting from the same overall value in the stock, but on that particular moment, the stock price has come down from a higher level to a level, and the reduction amount is equivalent to the dividend amount. So I think that's a standard practice. That's what happens typically. So basically, again, making the point that if you are one of those investors in a dividend paying stock whose income is say more than 15 lakh rupees, therefore you are subject to higher tax slab rate of 30%. So if you had sold this share, if I stay with this example, at 200 rupees, then your profit of 20 rupees would have been subject to either 10% or 15% depending on how long you've held that stock for. If you have held it for more than 1 year at the time of selling, then you'll be 10% tax on this 20 rupees. If you have held it for less than 1 year, then you'll pay 15% on this 20 rupees. Whereas if you receive this 20 rupees as an income, you're paying a tax of 30% plus surcharges. I know surcharges will be applicable on the capital gain tax as well. So let's keep that aside. So 30%, so effectively means that if you have 20 rupees of income as long-term capital gain, then your tax is only 2 rupees and 18 rupees is what you receive in hand. If your 20 rupees is as a short-term gain because you've held it for less than 1 year, then you'll pay 3 rupees tax, means 17 rupees you will get in your bank. But if you receive this as a dividend, then you pay 6 rupees of tax, means only 14 rupees is what comes in your bank. Clearly, I've simplified this. I'm ignoring the surcharges and the cess that is generally applicable based on the income and all that. So I'm keeping it aside. But in very simple terms, the difference between a capital gain tax and dividend income is between 10 to 30%. So that's a big difference. So you need to keep this in mind. If your tax rate, normal tax rate, is not 30%, you only pay at 10%, or your total income is not subject to any taxes, it doesn't matter for you. Then you can continue to keep dividend paying stock and receive those dividend income. But if you have income and your income tax is more than 15%, then capital gain, selling it for a profit and recognizing capital gain is probably better approach than staying in a dividend paying stock. Let's understand this with another example. Say 10,000 is a dividend income for higher tax slab means 7,000 in hand. So 3,000 tax gone. I'm ignoring again tax surcharges and cess here. So you get 7,000 rupees in hand. But the same 10,000 rupees, if it's a long-term gain or a short-term gain, you will get either 8,500 or 9,000 rupees. So you will get lot higher amount in your hands if it is a capital gain. So there's always advantage now to sell those stock just before the dividend is paid than waiting for it to uh, pay out dividend income to you. I hope it makes sense. Now let's understand the second part of my question, which was the intraday trading profit. I completely get that the people do intraday trading for a number of different reasons. They want to make quick money on a daily basis. They may have lower amount to invest, so they take the advantage of lower margins that are applicable to intraday transactions. So I completely appreciate and understand that if your drivers of doing intraday tradings are basically that because you want your limited amount of money to go further and be able to give you the exposure to a larger sum of investment, then it makes sense for you to continue to do intraday trading, and whatever profits you get, those will be treated as speculative gains. Therefore, you'll pay your normal tax on that. And you may not have tax as an issue in any case because your overall income may still be less than the minimum income on which you pay tax. Um, so it may not be an issue. But if you happen to be one of those people who have got decent income from other sources, or even from a share trading perspective, you overall make enough money that you could be on a higher tax slab, then you need to keep in mind that if you have the flexibility to, instead of squaring off settling your trades on the same day and recognizing your profits as speculative gains, you, if you could hold it, if you could delay by just one day, as against selling it at 3 o'clock in the afternoon, if you sell it next day 9:30 in the morning, your gain will be treated as a short-term gain, capital gain, as against speculative gain, which means from a tax perspective, you could reduce your tax liability from 30% to 15%. As I said, clearly, if tax is not an issue for you guys, or you're doing intraday trading for some of the other purposes like lower margin, for example, then clearly you don't have any flexibility to take advantage of this lower tax. But if you have flexibility, or there are particular trades when you have that flexibility, then you must keep this tax advantage in mind while trading on an intraday basis. Now, the last piece is the mutual fund. I think mutual fund historically, I know dividend options were preferred by number of investors. In fact, there was a time when they were the biggest attractor of new inflows into mutual fund. But even at that time, my strong view was that in the mutual fund, dividend is a misnomer. It's not an additional money that you get in the mutual fund. Whatever is your total value of asset, if it's a dividend paying program, dividend paying scheme, then they take some part of that asset liquidate that, generate cash, and pay that to you in cash. Means overall, your value of investment is reduced permanently. Of course, with future return, it may go further up, but it's basically you're drawing down on the value that you have created in that mutual fund scheme. So I've never been a great fan of dividend option for the mutual fund, but as I said, it was a popular scheme. A lot of people liked it. But with the tax changes that has come in the last year's budget, I personally believe for mutual fund investor, it's a complete no-no in my view. Of course, you kind of take your decision based on your own financial advisor's advice and all that. But if you ask me purely from a tax perspective, even the general mechanics in which the mutual fund work, dividend option is absolutely no-go area for me. I would always recommend growth option. They will always give you better return. They they will always give you money on the money that would have otherwise been paid as a dividend. So it's any day a much better option. So I hope you have found this simple to follow, simple to understand. If you have any comments or suggestion on my video, the content that I've covered, I would look forward to your comments. Uh, and last thing, I would repeat that if you've not subscribed our channel A to Z Learning, then I would urge you to please subscribe it, become part of our viewers community, and drive that commitment that we have taken to simplify the world of savings and investment. Be part of that journey with us, and enjoy the education and the awareness exercise that we are raising through our videos. So thank you so much for watching our video, and good luck with your investment decision. Thanks.